In this video, traders, I want to talk about news trading. Stick around. Hey guys, quick video for you to have a simple guide to kind of 4 different phases of news trading. Now, news trading can be good. It can also be dangerous depending on how you're doing it. So obviously keep the risk managed as always. That's what the disclaimers are there. I don't want anybody, listen, if you lose money because you accept the risk in a trade, you take the trade, you get stopped out, that's one thing. Fine, that's trading. That's absolutely acceptable. What I don't like to see is when people take too much risk, they don't understand the risk, all this type of stuff. It's avoidable. So be very careful if you're trading during news. All right, so you tend to have, you've got top tier news, second tier news, third tier news. Top tier news, FOMC, non-farm payrolls, that type of thing. Second tier news would be, I would say CPI, but actually that's probably first tier at the moment. It's like the lesser economic data points that, maybe new home sales, this type of stuff, maybe that's third tier, but you kind of go down where the market expectations for it to move based on this news are not very high. And you can often see this in the economic data calendars where you see it kind of a 3-star or red star and then orange and yellow or 3, 2, 1. So you kind of know what tends to have high impact, medium impact or low impact. So talking about the high impact stuff generally here. And really there's a couple of phases I see to news trading. One is the initial reaction. So the initial reaction, very often it kind of spikes one way or the other. And it might spike in one direction, come back, and there's opportunity to have wide limits kind of sitting there to catch this kind of opportunity. Now, one caveat with that is, at the moment, that's not really the play because very often the market's repricing based on news gets so important. But if you go back and rewind maybe a couple of years ago, forget about COVID, go even maybe further back, when news isn't really impacting the market too much, often the price would kind of shoot up, shoot down for liquidity and then kind of settle back where it was. And you could kind of trade that if you were, very, very disciplined, very, very aggressive, and you were quick. You could kind of have these limits staggered maybe, or be prepared to see it kind of run, fade that, come back in, and there was opportunities for that. So that's, to me, the initial reaction. And again, you're playing with algos here. So you're playing in a pool that's full of sharks and they want to bite your what's this off. They want to hurt you, they want to take your money, right? So you've got to be very, very strict and very, very disciplined if you're trading that initial reaction. The market's quick. If you get it wrong, you need to be out straight away. You can't be sitting there nursing a loss that's just going boom, 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 and it's down 100 points, 200, 300 because you've misread it. You don't want that. It's just game over. So initial reaction, there's opportunities, and I like to kind of categorize that as one theme. Like if you trade initial reaction, that's fine. You're scalping it. You recognize there's opportunity there potentially and you position for it and you're quickening out, and it's one type of structure and one type of skill set. Now we move on to some of the, maybe these are the ones that are more valid, I would say, for most traders. You've got the reprice, the trap and the chop. So after the data comes out, you often get this kind of initial response. Sometimes it just shoots off in one direction and it kind of stays there. Sometimes it goes up and comes down, and that's obviously where the initial reaction kind of fade type trade is. We're trying to find those extremes and seeing if you can get opportunity for a quick reversal back to the print it was at the open or an overshoot. But let's say it does this. This is the initial reaction here. So that's all done. And then it goes into what I call the reprice. So reprice is really where it's taken that data and it said, hey, I believe now the valuation of this market is different. All the collective amount of people, collective participants have agreed on that. Or that's not, they haven't agreed, and we'll sat there and voted, but that's really what showed up in price. Collective participants have said, I think this asset class is worth more, whatever that may be, and that shows through in a trend. And so the catalyst is the data. The data then has been digested by everyone, and they have said, hey, actually, I think this is now worth more, and we start to see people buying offers, causing the price to go higher. If you see that reprice, then your job is to try to join that, whether you're kind of trying to buy a pullback, or you're trying to buy a flag, whatever it may be. And again, I'm not going to go to the intricate details of triggers on this. I want to give a brief overview of categorize them in your mind and put them in different boxes. But that's a different setup to initial reaction. That's a trend following things, momentum. You're looking to kind of join that and assuming there's a reprice. Target-based approach first, I like to do. Look up, where's my target? Is it something like a multi-day high? Is it this, is it that? Okay, fine. How can I reverse engineer that? Do I want to see a little dip down that holds at support, fakes and goes? That might be nice if I believe the reprice is valid. That type of thing. Okay, chop. Next one is Price comes out, we have the little initial reaction, and then it just sits there and does nothing. And this is dangerous for a trader, because as traders, we want this. We want these big moves. And often we can position going, oh, it's going to go, it's going to go. And it just sits there and does nothing. Oh, it's going to go, it's going to go. Oh, no, it does. And it can chop you up and end up just spitting you out just due to stupid trades. So you've got to be aware of that. You know, if price doesn't really break the extremes after that initial reaction, then you don't want to get involved, really. Or maybe you have one go, and if it doesn't go, you call it a day. So just being aware of that. And if you start to see the market just volatility crush down, and what I call dirty candles, so red, green, 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 red, green, very shallow, little wicks, a little bit indecision, you want to step back. In fact, we had that today. Data came out, repriced it massively in one direction, and it kind of just sat there for a while, popped up a little bit and sat there for 30 minutes or so, just really tight, choppy little range. You're like, whoa, 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 you know, just let this resolve. You know, let us resolve one way or another, and then kind of strategize how you want to play this. Don't get caught up in this nonsense, because you know you're just annoyed. In the day, you look back and you say, I've just got caught in something that's stupid. Not like I made a bad call and gone short on a momentum thing and finally been stopped out on that, but it's just frustrating to get caught in that. So avoid that at all costs and be aware of that. Constantly be calibrating in your mind. Is this chop? Is this chop? Is this chop? And that helps you keep out of it. So the reprice, the other one is the trap. So the trap is like the reprice that reverses. I love the trap, man. I love the trap. It is the best, I think it's one of the best strategies out there. I just had a video where I talked about different trade kind of broad patterns, which should be up in a moment, or it's up in a few days, or it's been up already, so check that one out. But yeah, the trap is just such a lovely trade, because you've got that initial reaction, fine, yeah, starts to look, it's repricing low, and you might join that. You might think, okay, yes, but then it just reverses hugely, and it comes back to, you should always have a line, by the way, at the point it was before the data, because that's important, because that's how the price was valued before we had the data come out. So always have a line there. And often you get this where it starts to go in one direction, pulls back up, and all these people are trapped. And often that is a big reversal that can go for 1 or 2 days. All right, guys, that's news trading. There's 4 kind of broad ideas for you to help you categorize them and put them in different buckets. Take care, keep your risk managed. See you in the next one. Bye-bye.